Today's highlights: what exactly is the market brewing? Both volume and price are falling, ETFs are maxed out, giant whales are surfacing, market makers hedging hints at a trend, inscriptions are restricted causing community splits, and Bitcoin's digital gold status may be discounted. Friday, February 27th, BitcoinTV Chinese channel. Where is B-Chain? I'm Lucy. First, let's look at the most important crypto headlines from the past 24 hours. There's only one word to describe the crypto market in February: cold. Spot trading volume continues to decline, possibly hitting its lowest point since the start of 2024, and prices have also returned to the lower end of the annual range. Both volume and price are shrinking together. Binance's trading volume this month is about $75 billion, which is still the highest, but compared to the nearly $198 billion peak in October, it's clearly taken a hit. Gate.io dropped from about $53 billion to around $25 billion, and Bybit fell from roughly $41 billion to about $20 billion. Basically, both have been cut in half. This isn't a case of trading volume shifting from one platform to another. It's the overall liquidity level that's going down. More importantly, after the surge in October, over 70,000 Bitcoin open interest contracts have disappeared, which is about $8 billion in notional value. Leverage has been squeezed out, so the market has naturally quieted down. The current sentiment among investors is also very clear. They're reducing risk first and waiting for signals. No one is in a hurry to go all in. If trading volume can't recover, it's hard for the trend to maintain momentum. A period of consolidation and sideways movement is actually a more realistic scenario. Ethereum is no longer taking a laid-back approach now. According to Binance data, the 30-day realized volatility has surged to nearly 0.97, the highest level since March 2025. This indicates that the market has suddenly shifted from a slow, steady consolidation phase to a high-frequency fluctuation mode. While the price is still hovering around the $2,000 mid-range support level, volatility continues to climb. It's like both sides suddenly raising their voices in a negotiation. Bulls and bears are repricing, adjusting their positions, and neither is willing to admit defeat first. It's worth noting that increased volatility doesn't necessarily mean the price will go up or down, but it often signals that a decisive direction is about to be revealed. If this heightened volatility leads to a breakout through a key level, then a one-sided trend could be about to begin. If the price fails to break through for a long time but continues to swing violently, it's highly likely that the market has entered a choppy, back-and-forth consolidation phase. Overall, the era of low volatility is over, and ETH is now at a pivotal window that will determine its next move. The whales are starting to show up again. Data shows that the proportion of Bitcoin whales on exchanges has surged above 0.8. This is the first time since July 2024 that it's reached this level. Historically, whenever this figure breaks above 0.8, the market is usually anything but calm. Either it experiences intense volatility, or it hovers near a short-term bottom. This indicator measures the proportion of large capital inflows into exchanges. When the proportion is high, it means that big players are dominating the market rhythm. This often happens when prices have undergone a deep correction and retail sentiment is pessimistic. At that point, large funds start moving in and out frequently, repositioning themselves. However, it's important to stay calm. A high reading doesn't mean an immediate reversal. It's more like a sign that positions are changing hands and liquidity is being redistributed. Right now, the price is still fluctuating within the correction range. If it can stabilize and the proportion of whales gradually drops back to a neutral zone, that would indicate a short-term bottom is forming. Otherwise, the volatility may continue. Please like and turn on the notification bell. We will monitor news updates for you around the clock. Our channel takes a macro perspective, providing you with in-depth integration in just 15 minutes to help you quickly grasp major changes in the digital asset sector and enhance your understanding. Let's look at the news. Last night, Bitcoin seemed to have sensed the upcoming Nvidia earnings report in advance, starting to surge even before the results were released, with a single-day increase that at one point approached 10%. Even more dramatic, after Jane Street was sued, the mysterious sell-off that was rumored to occur every day at 10 a.m. suddenly disappeared. Even the well-known Bloomberg ETF analyst Eric Balchunas couldn't help but make a lighthearted joke, suggesting that the devil himself had finally vanished from the scene. But don't celebrate just yet, because this might just be a spark of emotion. The real stress test comes today, as a large number of options expire at once. Volatility will have to be recalculated, and the showdown between bulls and bears around key strike prices is the true moment of reckoning. Last night was just the warm-up, but today is the main course.
According to Grayscale data, today 116,000 BTC options and 206,000 ETH options are set to expire simultaneously, with a notional value totaling about $9 billion, accounting for roughly 20% of Deribit's total open interest. Against the backdrop of a generally weak market and shrinking liquidity, such a large-scale concentrated settlement could trigger a repricing of volatility and amplify short-term price swings. I think the crypto market is taking it much worse than we expected. Grayscale analyst Adam stated that the overall market was sluggish in February. There was an increase in medium and long-term call option trading, the SKU indicator rebounded, and some funds have started positioning for a rebound. However, the market still lacks new capital inflows and a clear main narrative, so sentiment remains cautious. He pointed out that panic at a bottom level has not yet appeared, so it is not advisable to judge the end of the bear market too early.
As options near expiration, the real driving force behind the scenes may be the market makers' gamma counterparties. Once the price approaches a large number of strike prices, hedging positions are forced to chase the rally or sell off, causing the market to suddenly accelerate like stepping on the gas pedal, moving toward the area of greatest pain. Option sellers are pleased, but if the price suddenly breaks through key strike prices, short sellers may be forced to cover their positions, and a short squeeze could be triggered at any moment. Against the backdrop of a bear market, this settlement feels more like a stress test. Short-term volatility is almost unavoidable, but the ultimate direction still depends on whether the money returns and if sentiment can recover. The expiration date won't change the overall trend, but it will lay bare the positions of both bulls and bears. The Bitcoin community is in an uproar again. This time, the core of the dispute is a proposal called BIP 110. Simply put, it proposes setting a cap on non-monetary content in blocks through a soft fork. In other words, stop inscribing images, videos, and code on the chain. Things like ordinals and runes should be restricted. Supporters say this is about correcting course and bringing Bitcoin back to its essence, to function properly as money. Opponents are panicking, worried that this move will break years of established consensus and tradition. Since the block size debate in 2017, Bitcoin hasn't seen such intense arguments until now. This time, the debate isn't about technical details, but about a more fundamental question. Should Bitcoin only serve as money, or can it have additional functions?
The controversy centers on BIP 110 setting the activation threshold at 55% of the hash power. In the past, upgrades like SegWit and Taproot typically required close to 95% to activate. Now, switching to a simple majority is seen by some in the community as a challenge to the traditional consensus. Blockstream CEO Adam Back, representing the opposition, criticized this move as a form of mob-style activation, expressing concern that it could set a precedent for even more radical changes in the future. Supporters, on the other hand, argue that the 95% threshold has effectively turned into a veto power for a minority of miners. Currently, nodes are split between Bitcoin Core and Bitcoin PS, while miners are weighing their profits under the dual pressures of declining inscription fees and the halving of blockchain rewards.
To dig deeper, this issue is fundamentally not just about whether or not inscriptions can be made. At its core, it's a tug of war between money, rules, and power. Supporters believe that the SegWit discount mechanism is essentially giving non-monetary data a discount. It's like someone using a highway as a parking lot and still getting a special rate. Not only does it take up block space, but it also disrupts price signals, so it should be left to the market to reprice. But the opposing side is worried about a different risk. If today we lower the threshold to restrict data, will we change the fee structure tomorrow? And the day after, will we touch even more sensitive consensus parameters? What makes Bitcoin truly valuable has never been its flexibility, but rather how hard it is to change. This kind of certainty is extremely important for institutions. What Wall Street is buying is stable rules, not some spur of the moment experiment by the community. If the rules can be changed at will, then no one will believe in the story of digital gold. At the end of the day, this debate boils down to one question. Is Bitcoin an ultra-minimalist monetary protocol, or is it an open data settlement layer? The real vote doesn't happen in forum arguments, but in the hard drives and clients of every node operator. AI and BTech companies are making a big splash. Block is laying off staff, its stock price is soaring, and it has gained full recognition from the capital markets. With the tax system for crypto now on par with stocks and bonds, Japan is ushering in its biggest policy windfall for the industry. In recent years, tech companies have been expanding at a crazy pace, so fast it's almost unbelievable. Saying it's like they're running on double speed wouldn't be an exaggeration. Block is a prime example of this. In 2019, the company had fewer than 4,000 employees, but in just 4 years, it shot up to 13,000, nearly tripling in size. As business exploded, hiring also went wild. The company's organizational structure kept getting thicker, with more and more layers added, but the winds of change can shift in an instant. AI is no longer just a little helper for writing code or generating reports. It's now embedded at the core of business operations, starting to redistribute efficiency and job roles. In the past, the competition was about who could expand more and hire more people, but now it's about who can be leaner and more efficient. The question has long since shifted from how many more people can be hired to whether these positions even need to exist at all. To put it bluntly, AI isn't just optimizing processes, it's redefining how many people a company actually needs to function properly.
Against this backdrop, Block's founder Jack Dorsey announced layoffs of about 40%, reducing the workforce from over 10,000 to fewer than 6,000 employees. He stated that AI has changed the way the company operates, and rather than downsizing in stages, it's better to complete the organizational restructuring all at once.
Block is invested in their own internal AI tools, and Goose is one of the things they're really promoting. I imagine what they're doing, which is what a lot of companies are doing, is probably plugging it into whatever works best at the moment and constantly reevaluating that.
Laid off employees will receive 20 weeks of severance pay, seniority bonuses, 6 months of health insurance, and a $5,000 stipend. Jack Dorsey stated that this move is based on a comprehensive review and stress test, is a proactive restructuring following technological upgrades, and he expects more companies to follow suit.
The capital markets reaction was nothing short of pragmatic. Block's stock price once surged by 31%. Looking at the Q4 data, gross profit reached $2.87 billion, up 24% year over year, and cash app revenue also increased by 33%. The market's algorithm has changed. If before it was all about scale, now it's all about efficiency. As long as AI can truly do more work, spend less money, and make decisions faster, layoffs aren't just about saving on salaries, they're about recalculating our profit margins. What capital is betting on isn't just saving a few salaries, but whether companies can become leaner, more stable, and more profitable. If small teams equipped with intelligent tools can actually drive growth, then the entire organizational structure of companies will have to be rewritten. And for ordinary people like us, the rules of the era have changed too. Being able to collaborate with AI may be far more important than working overtime and relying on sheer effort every day. Over the past year, the trend for crypto spot ETFs has completely reversed. The United States was the first to open the floodgates, followed closely by Europe. Suddenly, crypto assets moved from being an insider's game to appearing in mainstream brokerage accounts. In the past, buying Bitcoin meant you had to figure out wallets and private keys, which was a real hassle. But now, with just a simple tap in a brokerage app, you can buy products linked to Bitcoin. To put it plainly, crypto assets are gradually being integrated into the world of traditional finance. In the past, Japan was actually always very cautious, constantly monitoring exchanges, busy issuing risk warnings, and in no hurry at all to turn crypto assets into standardized financial products. But now the external environment has changed and other markets are also competing for this track. If Japan keeps waiting and watching, it will probably be left behind, so its attitude has started to gradually soften.
Japan's Financial Services Agency plans to amend the Investment Trust and Investment Company Act enforcement order to include crypto assets within the scope of investable assets for investment trusts, with the earliest submission to the Diet expected in 2026. If approved, spot ETFs could be listed as early as 2028. Previously, the FSA still stated that it was difficult to establish spot ETFs under the current framework, but now its attitude has clearly shifted.
Japan's Financial Services Agency is moving to reclassify crypto assets as financial products, putting them on par with stocks and bonds.
At the same time, regulators have also proposed bringing crypto assets under the regulatory framework of the Financial Instruments and Exchange Act, and plan to adjust the current comprehensive tax rate of up to 55% to a separate flat tax rate of 20%. These multiple measures together show that Japan is gradually laying the institutional foundation for the financialization of crypto assets.
If Japan's spot ETF really launches, then local retail investors probably won't flock to crypto exchanges anymore. They'll just trade directly through their securities accounts. Crypto exchanges will definitely lose some of their traffic, while brokerages and asset management firms will get a share of this new pie. But that also means they'll bear greater responsibility. With such high volatility in crypto assets, if the product ends up losing money, the sales process and risk disclosures will come under intense scrutiny. For global investors, once Japan, a mature market, opens a compliant channel, it will definitely be very attractive. After all, allocating crypto assets within a regulatory framework makes internal approvals smoother and compliance less of a headache. So this move isn't just a simple loosening of restrictions, it's about securing a spot for the next financial cycle.
On-chain monitoring shows that Vitalik Buterin, the founder of Ethereum, sold all 19,318 ETH in his wallet, totaling about $38,700,000 at an average price of $2,004 per ETH. Now, he only has 8.6 ETH left. Such a decisive action naturally draws extra attention from the market. Another high-value scam has come to light. The U.S. Attorney's Office for the Middle District of Florida stated that Christopher Alexander Delgado, former CEO of Glass Ventures, has been arrested on suspicion of orchestrating a Ponzi scheme involving approximately $328 million. If convicted, he faces up to 30 years in prison. Money comes quickly, but the drought that follows can be severe. This time, OpenAI and Figma have truly connected design and coding. The new integration links Codex and Figma, allowing developers to have Codex directly generate design drafts or instantly turn designs in Figma into code with a single click. U.S. Senator Cynthia Lummis bluntly stated that Sam Bankman-Fried is still trying to seek a pardon, but he hasn't realized that once the Clarity Act is enacted, his sentence could far exceed 25 years. He may have his plans, but the law doesn't always cooperate. According to U.S. media reports, the mining company American Bitcoin Corp, backed by the Trump family, has been under significant pressure during this bear market, posting a loss of $59 million in the fourth quarter of 2025. Even more striking is that its stock price has dropped nearly 90% since its peak last September, almost returning to its original level. When the market cools down, mining companies are the first to bear the brunt.
The most common mistake in the market recently is mistaking range-bound fluctuations for the start of a new trend. As soon as there are two bullish candles, people shout reversal. When two bearish candles appear, they start talking about a crash. But the truth is often not that dramatic. A low-volume rebound is just a test by capital, while high-volatility declines are mostly emotional outbursts. In an environment with insufficient liquidity, prices are more like being pulled back and forth, rather than moving along a single trajectory. There hasn't been a significant increase in trading volume, and the structure hasn't truly moved up or down. So so-called breakouts often have limited sustainability. What really hurts retail investors isn't whether their trend judgment is right or wrong, but being lured in by false signals, only to get stopped out in the opposite direction right after opening a position. The less direction the market has, the more it tries to create a sense of direction. Breakouts without trading volume are often just emotional illusions. All right, that's the in-depth breakdown for this episode. Our channel has always focused on the core narratives and value discovery in the digital asset space. We don't deal in empty talk. If you agree with our logic, feel free to stay updated with the latest news. Turn on real-time notifications and don't miss out on important information. If you want access to higher-level research reports, you can also follow our advanced channel. From Monday to Friday, we share in-depth reviews of market cycles to help everyone find certain opportunities within the trends. See you tomorrow.